The information and opinions expressed in this video are of a general nature and are not intended to be investment advice, research, or recommendations. Please consult your investment professional for your own circumstances. The information in this video reflects the opinions of Arca Labs and the video's participants on the date of production and are subject to change at any time without notice due to various factors. Arca Labs is separate and unaffiliated from any third parties participating in the video presentation, and Arca Labs is not responsible for any third parties' products, services, or policies.
Welcome to Tokenization Talks, powered by Arca Labs. I'm Annelise Osborne at Arca Labs. We are focused on innovating responsibly, and we are excited to bring you institutional thought leaders in the digital asset space. So our guest today is Victor Jung, who is head of digital assets at Hamilton Lane. Hamilton Lane is a global alternative investment manager with over 100 billion in assets under management and over 700 billion in assets under supervision. So Victor, thank you so much for joining us today. I'm really excited to have this conversation with you.
Thanks for having me.
So you started in June and you've been extremely busy since you started. I'd love to hear about what your approach is, Hamilton Lane's ideas of digital asset strategy and where you see it going.
Okay, so let me first start where this position came from. So I think I will be probably the first or second hire on the private market space with the title of being the head of digital assets. And what that means is, at least from our firm's perspective, is to provide more access and get ready for the future in terms of having a new audience, having access to this asset class called private markets as alternative assets. And why is that? If you look back in history, I mean, there's a lot of changes that have happened in the public markets. In 1990s, for example, where there was an era where you had to pay an 8% brokerage fee to buy a stock. If you look at the great institutions that have democratized that 8% to a zero-based commission fee, starting from Mr. Jack Vogel setting up Vanguard, Charles Schwab, Fidelity, and then you have the tech companies like eToro and Robinhood coming in. I mean, they've democratized the entire space on the public equity side, and what that causes. They changed retail participation in the 90s from 3% to a double-digit minimum 27% on direct retail holdings, plus 47 to 48% of stocks in the public equities market being held by funds and ETFs. So that's when the democratization topic comes into the scene. And when you look at today, yes, it has been democratized, but there's the universe of stocks that a retail buyer can get on the public markets has 1/3 from the 90s. There were more than 9,000 stocks to invest back in the 90s. Fast forward today, you have less than 3,500, and it's all FANGs. So when you're a retail, what options do you have? You no longer can invest in the likes of Intel or Amazon. After IPO, you can still, have some returns to be made, and you're left with, three choices, which are, stocks, meme stocks, and cryptocurrencies. And some of them, if you do your homework well and you're lucky, you would be able to make money, but 90% of SPACs have traded are trading below value. I don't need to explain to you what happened on the crypto side of things. I mean, it's clear that you're losing money, and meme stocks are, you're not making any money out of it. Hence, our management in the Hamilton Lane, they saw a trend of a structural democratization that has to be kicking in, because if you don't have that retail universe, if they don't have the access to a stable asset class to invest in, to retire and make money from, I think there will be severe consequences also from socially and financially. Hence, we're like, hey, it's not that we love it, right? I mean, we like economies of scale. We all proud ourselves by saying we're institutional investors, but if this is something that is meant to happen, and together with all the wealth transfer that's happening, and with all the tech players that are coming in that are disrupting this market, and the Department of Labor issuing information letters hinting that, hey, this needs to be, the 60/40 needs to be reviewed. We thought, hey, look, maybe this digital / blockchain technology will, just speed up this growth together with regulators and innovation on the product side through efforts from the GPs like ourselves. Hence, this is why I was tasked to come in, report directly to the Chief Risk Officer and CEO to see, hey, what can we do here to provide a good solution to a new audience, right? And this is not a pro bono. I mean, we are all a listed company and we're all doing this for the money, but this is one of those times in where we think there's a purpose in a market where there's no access today towards retail. Here, retail, I don't mean only the 401k, but also the underserved accredited investor that doesn't have access to this kind of products. Hence, our digitization journey will be more focused on pilots to test with the underserved accredited investors to begin with, and get ready for the future. Yeah.
That's great. So it sounds like you have you're thinking long-term, right? And where the markets are going to be in 5 to 10 years, which is, I think, what we all need to be doing. And then you're doing two things. One, you're offering up private market investments for the retail that aren't there anymore, right? To your point about the stocks. And then while you're doing that, you're also serving kind of the next generation of the wealth transfer, which are the millennials that will be, I feel the millennials will be the ones that are running both different groups and have their own checkbooks from a corporate perspective, but also, everybody wants to invest kind of on their phones, right? It's a wholly different environment with the upcoming wealth transfer tomorrow. So that's great. So you started, I feel like you guys were really one of the first institutions to step up and tokenize the funds. And you did the first one with Addicts back in Singapore. Can you talk us about that, what you learned from that?
Yeah. So first, I think it's very important to mention once again that this is not cryptocurrencies, right? And there are a lot of people, when they hear this for the first time, they think, greedy fund managers now opening up to crypto. No, what we're doing is using blockchain technology and adapting that, using those solutions in private markets context. And having said that, I think for the sake of this argument, it's worth mentioning that the 3 continents are very different in how the private markets tokenization are being developed. I would say the most unified of all is in Asia, and particularly in Singapore. First, it's a city-state. There's no exports there. I mean, it's all innovation that will keep the country moving. Hence, you have a very proactive approach from the regulator to provide licenses and be very closely monitoring the development of this space. Now, this has helped us tremendously in doing due diligence on the platform. Why is that? Basically, the MAS, the Monetary Authority of Singapore, they wouldn't grant a license to anybody who is not fit and proper. And if you look at the cap table of the shareholders behind this company, they're all the top 3 leading financial conglomerates of Asia, starting from Japan, Korea, now Thailand. Now you have even UOB, which is the 3rd largest Southeast Asian bank out there. They're all having a significant stake behind this company. And for us, it was very clear that there was a path in the future when it comes to these banks' wealth management journey to offer it to a sector that they call the wealth continuum. This means so there's 2.3 trillion of assets being managed by the top 20 banks, global banks that have a headquarters in Singapore and Hong Kong. If you look at some of their shareholders, they have the existing AUM, but they also have a lower tier from the 1 million, the mass affluent audience that don't have access to this asset class, but they are in a way qualified to invest in, but they don't have an access to. So you could see, for example, UOB, they had acquired Citibank's a branch in 3 countries in Southeast Asia with the goal of providing some of those solutions in a tokenized format. I mean, that's a long-term vision that I speculate. Hence, for us, that was a clear path of, hey, we should be in as a content provider. Now, what we learned there is, hey, you have the issuer, the token exchange, and the regulator moving together, and that's beautiful. But on the other hand, you could also see maybe scale could be something that lacks compared to the US. I mean, US, you have an entire, like a massive market, like let's say the 401k market is more than 3 trillion alone. Singapore is at the most like not more than 6.5 million in population. So how much can you get out of it, right? Hence, the interoperability and cross-border becomes much more important. And because they're so highly regulated by the MAS, right? This has to be first and foremost a security offering. So it's a registered security. So there's very little that you can do in terms of innovation, creativity. Like you cannot access. There's not an area where you can even try to go down the retail line. So it has to be strictly an accredited period. There's no buts and noise. Very boring. Very straightforward offering that is on a digital format. I think that was our first case in Asia.
So then your recent announcement came out with Securitize that you're offering.
Yes.
On Securitize. Can you kind of walk us through what you're looking to do there?
Yeah. So to your point, Annelise, so my mandate is global. I cover Asia, Europe, and US. From Europe. So we have done, I mean, we're still doing other efforts in Asia, but US, that's the capital city of financial markets. That's where all the attention is. Hence, we took a long time to underwrite who are the potential partners there. And we came to the conclusion that Securitize would be one of them. And again, coming back to my point on the development and the trend of each continent being different. ADDX in Singapore, they are a 3-in-1. They are a primary issuer, a secondary trader, and they are their own wealth manager, and they also have their own, let's say, transfer agency, right? In the US, a company like Securitize, they started as a transfer agency, right? Then later on, they acquired an ATS, and they kept on building it up. So it's more, I call the Wild West, right? I mean, you have very traditional players like T0, like, you know, it's everywhere, but T0 was more, I mean, they're the one, in my view, that started it out more as an exchange. But for us, it was more of a, who is the most compliant, who is the most boring, but the most reliable in terms of settlement, et cetera, et cetera. So we saw how Securitize went from a transfer agent. They were building the block slowly, prematurely, and the team that they have in terms of the ex-regulators being part of them and coming to us, ensuring to us, hey, like these are the solutions, right? That gave us a lot of comfort. Hence, we ended up, agreeing in tokenizing 3 offerings. The 3 of them are all different. And here, without going too much into details, each 3 funds, we expect to address a different audience. So you have, the QPs and the AIs, and you have the 3 or 4 different segmentations in the U.S. market. Now, we don't know whether we will succeed in all of them, but I think we had a good buy-in from both management to at least put some effort to see, is there a way to access with structuring and product innovation to access an untapped audience.
That's great. So then moving on, you recently announced that you were launching a fund on provenance, which is
yes,
super exciting. And this is a natively digital fund, I believe. Can you talk about that?
Yeah, so this is, again, we try not to overlap our funds, and this tells you how strong we are in terms of piloting, right? So the three funds that we have, we're in discussion with Securitas and the fund with in Asia, they're not overlapping, and the same goes with a fund in with Figure. This is a 40 Act, and this is probably, I mean, there has been some other 40 Acts such as yourselves, right, being done, but on the private markets 40 Act, I don't think there has been a case yet. Hence, we're still in the makings of it. It's not like launched yet. We're still having weekly conversation in order to properly launch this, but we just want to see whether this will work or not as a 40 Act. If we get to figure this out properly, and on a pure digitally native format, and how, let's say, the trading works, it would give us a bit more indication of how we should structure our funds going forward. What you have to know, and as you know, evergreen funds, the 40 Act, the interval funds. I mean, we call them evergreen, semi-liquid in Europe, Asia. In the US, it's more the interval 40 Act funds. They are the biggest minority of the private equity world. As you know, private markets are all about 10 years, close-ended capital call funds, right? Again, I hope you can see that Hamilton Lane is trying to push on the 40 Act to have a greater access to the people that need it. It's not easy to get the liquidity provisions that we have. It's not fully liquid. That's why you call it semi-liquid. There's let's say 5% per month liquid provision in all of these funds, but they're all fully paid in. In Europe and Asia, you have an IC number, which is an electronic tag to all of these shares of the units of the fund. But if these pilots happen to work well, so these are collaboration with exchanges and the RIAs, if they can help us on the close-ended and capital call ones to make a sustainable, viable solution for retail and the creditor to come in, that's good. But also at the same time, we are already partially solving the problem by having an interval fund like the 40 Act to the exchanges to see, hey, let's see how this works out and the liquidity works. If there's big demand here, I would think that our team would give greater focus on making more and more evergreen funds for the audience. It's like a REIT for real estate products, right? I mean, it has been done before, but not on the private equity side. Of course, different regulatory context, but that's what we're trying to see and figure out. Hey, can we go through the regulatory complexities and do good to a new audience with a quote unquote safer asset class that has content in.
No, it's super exciting. And the more the world develops, I think, the more offerings that are out there. So we did our ARPA US Treasury Fund, which is a 40 Act fund.
Yes, very famous. Yeah.
There's a few other money market funds out there as well. So but I think we need to expand that universe. And the more innovation in the space, the better. And the more traditional funds that we see tokenized, I think it's fantastic. So I could talk to you all day, but I know that I really appreciate your time. So I'd love to kind of close it out with hearing about what you see happening in 2023.
2023, well, we hope by 2023 we close a chapter not only in Asia and not only as we've done in Asia and US, but also in Europe. I mean, just shocking news in Liechtenstein. Private equity funds can be sold to retail Annelise. Things are moving very fast. This was just a few months ago that they changed it. So I think the entire world will have now pilots on the private market space, and this will be no longer a novelty. I think where we would head to in 2023 would be, I think there will be, tokenization talks using blockchain on equities and bond side of things. They have a lot of friction there that, we as private markets player, we wouldn't have known, but there's a lot of discussions being held. But I see a mass adoption, again, with everything that has happened with the FTX fiasco, of reliability, execution, trust, and mainstream institutions like the top three banks, right, coming and adopting blockchain in a very secured way. and this will affect private markets in terms of mass adoption. You'll see many more pilots happening at greater scale, especially in the US.
No, I agree. I believe that there's a lot more institutions paying attention. And, we chatted about this before, but, and it's very quiet. I think there's going to be people that haven't announced in the space that will announce.
Oh, yeah, definitely. It's the best kept secret in town, but they're just waiting for this to be announced. I agree.
And I think we're not quite at the inflection point where, we don't talk about blockchain behind the scenes, but I do think we're going to see a lot more in the institutional space this year. I think we're start to build out kind of both sides of the market. I think we can build out the sell side if we have the buy side, so people have to get used to custody and holding digital assets. So I think that'll be
yeah.
And I think once we have more on the primary market, we'll have a bigger secondary market, and the secondary market will drive the primary market. So I think we need all of the innovators like yourselves to step up and launch these pilots, which will develop kind of into a more standard ecosystem. So Victor, thank you so much. I really appreciate it. I know you're busy, and it's been great talking to you. And I would love to have you back whenever you're ready to talk about more digital assets institutionally.
Thank you very much, Annelise. It's been a pleasure. Talk to you again.
Thanks, everybody. Take care. Bye.